We traders very well know the importance of volume while analyzing a chart. And traditionally, we look at volume in the x-axis with respect to time. But what if I told you, you can look at it from another dimension altogether and start analyzing volume with respect to price? And that is where the volume profile tool and the strategy comes in. You get an additional layer of information while analyzing the ever simple concept of volume. So in this video, we'll learn the tool and the indicator which is called as volume profile. We'll understand why it is important to look at it this way. We'll also get into practical applications and strategy implementations of this volume profile tool. So in this video, let's discuss volume profile in a very detailed and practical way that will benefit you. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to Market Feed. So first, let's start with what is volume profile. Volume profile is a very versatile tool which can be used to plot important price levels using the simple volume concept as we know it. But there is a key difference here. As we explained earlier, volume here is plotted in terms of price and not in terms of time. Let's understand this with a very easy example. Take the case of Raju, who's an onion wholesaler. He has a large warehouse where he stores thousands of kgs of onions and he resells to smaller retailers. Every day, Raju is selling huge quantities of onion to different retailers. Now, we know that onion price is very volatile. So what is happening here? Try to visualize it in the form of a chart. Onion prices are moving up and down and every day, Raju is selling different volumes of it. Okay, now try to visualize that in the sense of a normal chart that we read every day in the stock market. But Raju has a problem here. Since onion prices are very volatile, every day the trades, the sales are happening at different price levels. Some days it will be at 60, some days it will be at 70, some days it will be at 50. Now, with the very volatile pricing of onion, Raju wants to understand at what prices he is selling maximum number of kgs and what prices he is selling very lesser quantity. So what can he do here? The only thing he can do here is to visualize volume in the price chart here. Now this is how a business person would think. At what prices did maximum number of transactions happen? Now similarly, even traders should start thinking about what different prices the maximum number of trades happened in. And by looking at the volume profile tool, traders can understand what exact level did the highest number of transactions happen. And whenever prices come back to this zone, it's going to be a very important zone. So you'll understand that this highest level of activity is a very important support and a resistance level. They are areas of very high liquidity where prices can move predictably. Volume traded is a data point which cannot be hidden. So along with price and volume, these are what I call as two fundamental truths in the market. They cannot be hidden at all and they will reveal a lot of things that you need to understand about the stock prices. And looking into volume data in depth will help us understand good support and resistance levels, levels of low liquidity and even strength of the trend. So by understanding volume, if we get to all of this, we can then discuss even a volume based setup here. So volume profile helps you understand what prices did different levels of volume get traded in, and always it is looked at in a fixed time frame which is decided by you. Let's get to that very soon, but first let's look at this example here. So in this case of this candlestick, what can you see? The candlestick has an open range, it has a close range, it's a green candlestick, and it has a high and low created with the shadows of the candle as well. And when we use this tool, you can see that the volume is plotted across different price points here, and the largest place where the volume got traded in is called as a point of control or the POC. Now here you can see that most volume got traded in this very zone. And there is very low volume happening in this level. So now what do you understand? You can see that the very normal candlestick that you saw earlier is not as normal as it sees. You can see that at this point, there is very high volume or very high activity happening. And at this range, which is the middle range of the candle, there is very low candle or very low volume happening. So the bottom area here, you can call it as a high volume zone, and the middle area with lesser volume, you can call it as a low volume zone. These high volume zones have a gravitational effect. That means whenever the price comes there, it often gets trapped and it moves very slowly. The price of the stock moves very slowly. But in these points of low volume, the price moves much faster because there is very low liquidity and the price can move as fast as it wants. And the shaded or highlighted part that you see here is called as a fair value. This is where 70% of all trades happened. So you can see that if you add up all the volume here, it'll add up to 70% of all the volume which happened during this candlestick. Now you've plotted this volume profile tool, but the most important part is reading this candlestick along with the volume profile to understand whether it is a bullish candle, a bearish candle, or a neutral candle. Let's start with a bullish example. So you can see that price started at this level, it moved down throughout the day, but it moved back up and closed at the day's high. But where is a volume profile here? Where is a fair value being traded? Most trades are happening at the lower level of the day. It shows that the buyers are very strong here. You can see that the fair value of this candlestick is somewhere near the bottom, but the price managed to move up or break out of this gravitational pull of the fair value and it closed above the level. So again, because the price moved out of the gravitational level and closed above this fair value, we can call this as a bullish candle. Now in the case of this bullish candle, you can see that price has closed above fair value, and tomorrow or in the next candle, what is most likely to happen? The price is here, and if it comes down back to this POC or this point of control where the most volume got traded in, it will very likely act as a support for this candle. And in the next example, you can see that price opened somewhere here, it moved up but it could not sustain, and then it moved back down to the day's low. So again, you can see that the fair value is somewhere at the top of the day. So sellers were very strong and they pulled down the stock price away from the fair value, and this is a bearish candle example. In this bearish scenario here, we know that price closed below the fair value. So if tomorrow or in the next candlestick, the price moves back up to this high volume range, there is a very high chance that it will act as an important resistance for the stock. And in the third example here, you can see that it's a doji candle. There's not much price movement and the stock has closed very near to its fair value. So it's a neutral candle here. So to summarize, listen to this very carefully. If a green candle is formed, if a bullish candle is formed and the fair value is underneath the closing price, that means that the stock is bullish. If a red candle forms and the fair value is above the current closing price, that means the candle is bearish. And in the third example here, we're not able to define a trend. So we'll have to look at multiple candlesticks together to understand what is the current trend here. So now we looked at three examples. In a green candle, how do you understand if it's bullish? In a red candle, how do you understand if it's bearish? And in a neutral candle, you have to look at longer time frames. But before wrapping up this concept, I want to look at two more candlestick variations which can help you understand trend reversals. So let's take this as a fourth example. In this candlestick, price moves up very quickly through a low liquidity zone. Again, we know that in a low liquidity zone, price will move up very fast. But what happened towards the end of the day? The price got trapped in a fair value zone. So what is the logic here? The trend was very strong towards the start of the day, but towards the end of the day, it could not keep up the trend and escape this fair value zone. So here it is a very clear reversal opportunity. Do you understand? Buyers were not strong enough at this price level. Towards the beginning of the day, they were very strong and the price moved very fast. But towards the end of the day, the buyers were not strong enough and they could not escape this fair value zone. The same situation can be applied to a red candle as well. If the price moves down very fast through a low liquidity zone, but towards the end of the day, it closes inside fair value, that means that sellers started the day very strong. But towards the end of the day, they got trapped in this high gravitational zone. That means they were not able to continue with their selling pressure. So if price moves very strongly in the beginning but gets trapped in the fair value zone, it is a good reversal opportunity for you. So now let's quickly look into how you can practically apply volume profile into a chart by looking at this example here. So first, when you open TradingView, you have to go to the left side of the screen. You have multiple charting tools here. You should come into this forecasting and measurement tool section. Click on that and you have two volume profile based options here. Now my favorite is a fixed range volume profile. That is the only tool that you need. You have anchored volume profile, inside indicators, you also have session volume profile, but all of this can be simulated just by using this one tool which is called as fixed range volume profile. As I said earlier, this tool is to be used for understanding volume between two different ranges or two fixed ranges, and that's what we are going to do here. We are quickly going to plot the daily, today's volume profile chart of Cochin Shipyard stock right here. So in this example, you can see that even though the stock moved up and down throughout the day, the maximum number of trades happened in this highlighted zone right here. You can see that is a fair value. But in order to make this tool more robust and more effective, let's reduce this fair value area. So I'm going to double click on this volume profile chart here, and I'm going to decrease this volume profile area to 35%. That means it will highlight for me the area where 35% of all trades happen today. And you can see that it is much more simplified here. It is just this small zone. Whatever analysis that we talked about is to be done after the day's closing. So let's assume that Cochin Shipyard closes at this level today. What can you understand? So the price moved throughout the day. It's a red candle in the daily chart, but the price has closed inside the fair value for the day. Out of our 5 examples, which example is this right here? And what does it say? Take a minute, I'll wait. So this chart here is indicating a reversal for the next trading session. So if price closes like this inside fair value with a red candle, it says that sellers started the day very strong, but towards the end of the day, they got trapped in this high volume fair value zone. So it means that very likely in the next session, there is a chance for a reversal from here. Here we are trying to analyze one single day's volume profile and trying to predict what could happen on the next trading day. But if you want something that is more long term, let's say as a swing trader, you should be looking at analyzing the volume profile of an entire week. So intraday traders can use a previous day's volume profile to understand the trend of the next day, and positional or swing based traders, they can look at multiple weeks or even multiple months of volume profile if the stock is consolidating to understand what is the trend, and also understand the POC, which is a white line right here, which will act as a good support and resistance for the upcoming trading sessions. So I know it's a different concept for most of you to understand and grasp, but once you do it, it's going to be a very powerful tool that you can add into your trading arsenal. You can combine it with your multiple other ways of analysis, and you can make sure that you start increasing your probability of winning trades. So that's it for the subject of this video. As always, if you have any doubts, you can come down into the comment box and you can ask all your doubts there. Either I'll answer it for you or other experienced members of our community will help you understand the same. If you like the video, make sure you hit the like button and subscribe for more such practical content. This is Ajay Ajith signing off. See you all again. Bye bye.